everyone, and welcome to the latest installment of our webinar series on recent developments in life science. Today's topic is on keeping the lights on, strategies and tactics for raising and preserving capital in a challenging time. And we're fortunate today to have four panelists with a wealth of experience in navigating kind of every type of biotech situation in the capital markets. I'll let each of our panelists introduce themselves. I'll say a couple words about them, but just as a prefatory matter, this session is being recorded, and it also nothing we say constitutes legal, medical, or spiritual advice of any kind. So just keep that in mind. Sean McCarthy is the CEO since 2010 of Cytomics. He's been in biotech for about 25 years, has done just about almost every type of financial and strategic deal. He was a CBO before he was CEO. So he's really kind of seen it all. And we're fortunate to have Michael Brinkman, who's the managing director and joint head of biotech for Jefferies. He's as active as anybody in biotech banking over a long period of time. And we're also fortunate to get the perspective of two well-known investors, Nimish Shah at Venrock, who for over 15 years has been investing in publics and crossover biotechs. Again, with a wealth of experience, kind of seen it all. And finally, Chen Yu, who's the founder and managing partner of TCGX, TCG Crossover Fund. Before he founded TCGX, he was at Vivo for many years. Very experienced hand in navigating kind of every type of biotech capital markets situation. So with that, I'll let each of our panelists briefly say a few words about themselves. Sean, you want to start?
Sure. Thanks, Sam, to you and the Goodwin team for organizing this very timely discussion today. It's a real pleasure to be here. Sean McCarthy, CEO, chairman of Cytomics, as Sam said, been with the company quite some time, actually since pretty much the first venture financing of the company by Third Rock Ventures in late 2010, and it's been quite a journey. Cytomics is a company that focuses on what we call antibody masking. We developed a very innovative strategy for improving the therapeutic window of therapeutic antibodies using a protease-based masking strategy. We're the first company to have done this. We've really been the innovator in the space, and this has turned into a broad field now with many other companies and organizations, large and small, pursuing similar approaches and enjoying considerable success. So happy to talk more about the company and our journey, particularly over the last 6 months.
And Michael?
Hi, everybody. Michael Brinkman. I am co-head of biotech at Jefferies and based in Palo Alto. Have had the pleasure of working with everybody on this panel. So we're delighted to be here and be talking with old friends. So thank you.
Nimish?
Hey, everyone. Nimish Shah. I'm a partner at Venrock. Venrock was started in the 60s by the Rockefeller family. I focus on investing in late-stage private and small-cap public biotech companies. Thank you, Sam, for having me today, and look forward to the panel.
Thanks. And Chen?
Hi, I'm Chen. Basically, as Sam mentioned, basically managing partner at TCGX. We're a mixed mandate fund. We do both public and private with no restrictions. So very excited to be here today.
Thanks, Chen. So I think it'd be helpful to set the landscape a bit. And Michael, it would be good if you could start by just giving us a sense of how things are going this year compared to prior years.
Thank you. Happy to do that. And we had a few bullets which might be helpful to pull up on the page or put up on the page. But we're in I think everybody knows where we are from a big picture perspective. The market has really shut down this year. I think things were obviously we had the history of the COVID boom for biotech, came to a crashing end in the second half of 2021. After 3.5 years of misery, things looked very good. September and October, I think a lot of enthusiasm as the XBI recovered and the financing environment seemed to be recovering. We had a period where I think 7 out of 8 of the last IPOs were trading up, going into the election. So lots of enthusiasm. And then, of course, with the RFK announcement, things started to unravel for biotech. I think as the industry focused more on Trump and how to make money under Trump, biotech really just disappeared from focus. Nobody was interested in our space at all. And on top of that, we had a lot of volatility as RFK's rhetoric seemed pretty scary for the industry. So we're now 6 months into the year. We have a backdrop that has been quite bad from a total issuance perspective, down 2/3 year over year. Some interesting stats, obviously, four IPOs only so far this year. Historically slow rate. 2023, which is obviously right after in the aftermath of COVID, was the only period where we had fewer pricings. 3 in that case here, 4, but all right at the beginning of the year. The IPO market at this point is completely shut down. The follow-on market also looks very slow by comparison. Year over year, follow-on issuance down 2/3 or down to 1/3. 152 follow-ons at this point last year. Last year obviously wasn't a record year, but was a decent year. 152 versus only 50 at this point. So obviously a very slow offering market. One of the trends that we'll talk about today is in this period, more than half of the offerings that have been done have been what we call concurrent offerings. We did the first of those a few years ago for a company called Resolute, where you announce the data and the financing at the same time. So essentially, investors are getting to invest with the benefit of full knowledge of the data before the rest of the industry or the rest of Wall Street gets to see the results. So pretty much what I call legal insider trading, in that you're getting access to confidential information and then allowed to buy on it. So I would say in my 30 years in investment banking, the best opportunity I've ever seen for investors to really do well. And I think that these deals sort of represent the bottom and represent a true buyer's market, the ultimate buyer's market. And I think these concurrents are a very significant trend in our industry, but also hopefully will be the key driver to turning the industry around, investors making money, and sort of restoring confidence in the sector. The last couple of weeks, we've actually seen a lot of this concurrent offerings have been driven by sort of an upside down market where stocks go down instead of up when companies announce the news. And so the concurrent approach is a way to try to get ahead of the stock going down. We'll talk a lot more about that on this panel, but finally this week and last week actually starting to see some companies respond favorably on news announcements. 2 companies this week have announced data, and we've seen the stock go up significantly. So those are Sedara and Nectar. So at least an encouraging signal here this week. So hopefully that gives a little bit of a backdrop, Sam, without stealing all of the thunder from the rest of the panel.
Yeah, and those positive receptions contrast with announcements of positive data that were greeted with indifference or lukewarmly earlier this year by other companies. So that is a difference. So, Sean, I want to start by asking you about the concurrent deals that Michael's talking about. Cytomix did one just in May. Congratulations, you raised about $100 million in conjunction with announcing positive phase 1 data. And I'd be interested in hearing your thoughts about not the post hoc, it was a great success kind of analysis, but before you knew that this was going to work, what were you thinking? How did you evaluate this concurrent deal structure where you announced data in conjunction with launching the financing, with investors already, familiar with the new data versus the traditional model of you announce data, you let the market react, and then you raise. Um, what was your thought process in evaluating the alternatives and how you picked?
Yeah, thanks, Sam. It was certainly a multi-layered and complex thought process and quite an extended period of time over which we evaluated what exactly to do. So just to set the scene, we began a phase one study of a new drug candidate in Q2 of last year. This is a really exciting program that CytomX is developing called CX-2051. It's an antibody drug conjugate targeting EpCAM, epithelial cell adhesion molecule, which is highly expressed on most solid tumors, particularly highly expressed on colorectal cancer. And we've always thought it offers a tremendous opportunity for developing an ADC, potentially other formats. Using our masking technology, without going into details, the masking is essential, we believe, to opening a therapeutic window for EpCAM because it's a target that's expressed on many normal tissues. So, target that we've had a long-standing interest in. The study, we committed to enrolling only in colorectal cancer in the phase one study. So we anticipated that the study could move pretty quickly, and we set guidance when we began the study in the first half of 24 that we would have initial data in first half of 25. And that was really, really important for us because as we looked at our cash runway coming into 25, we knew we'd have about 12, 15 months of cash coming into that data and would need to raise. So looking to raise on positive data. A study enrolled really well, and we were encouraged over time with what we were seeing. And then we came into 2025, and it was just, for so many of us running our companies, we were just wondering which way is up in this world, not to mention the biotech markets. And Michael's already alluded to a lot of the headwinds. Our stock went to a low of below 50 cents, market cap below 50 million, significantly below cash value, so negative enterprise value. And we realized coming into this year that there's going to be another year of the downturn, which began. It's hard to remember when it began, but I think it was 2022. So, however, we kept our heads down. We actually did a restructuring of the company in January to ensure we had runway to get to data with at least 1 year of cash. Maybe we could talk more about restructurings later on as one component of keeping the lights on. And we took a data cut in April, and we were just super excited by what we saw. The drug's really working. This is a highly active drug in late stage CRC. We felt that this would be a data set that, under normal circumstances, would be very well received in a functioning market. But we were not in a functioning market, so we had to think very carefully about, well, how are we going to do this financing? And in talking to our banking colleagues, including Michael and team, we seriously considered putting the data out and letting it run and financing on the heels of data in the conventional way. But it was very, very hard to really justify doing that based on the statistics of the last year or two, where most data sets, as Michael said, for inexplicable reasons, even strong data sets, your stock trades down. And our stock has seen quite a lot of volatility over the last 1 to 2 years in any case. That said, we did see it as a viable option. We did think about potentially being the first to do one of these types of deals, a conventional follow-on this year. But we received some inbound interest in advance, including a term sheet from Longitude Capital, and we were able to negotiate that to a premium to where the stock had been trading over the last couple of months. And we began a process under CDA, confidential discussions with a limited group of investors to socialize the data and just take the temperature of what does this data look like, what's the reception, and actually also what are investors' key questions. That was a helpful part of the process, really understanding the key questions in a confidential setting. We felt encouraged that deal could happen. Things moved pretty quickly. As always in a market like this, there was quite a lot of uncertainty after a week or two of those discussions. We were still thinking that we could launch this deal into the public market. That continued to be our plan A. But really, at the last possible minute, we made the decision to do the concurrent deal, and we worked with Jefferies and Piper to do a confidential one-day virtual roadshow, and that was on a Friday. And over the weekend, we realized that the demand for the deal was very, very high. We set out to raise 75 million. We raised 100 at what ended up being a 40% premium to where the stock had closed on the last day of trading. We announced the deal concurrent with the data. And the data was well received in conjunction with the financing, and the stock has done well since then. We've traded up quite nicely, and overall, it's just been a really, for us as a company, an absolutely terrific outcome. It puts us in a place of having cash runway now well into Q2 of 2017, and able to get back to executing, running the company, and driving this program to the next key inflection point in Q1 of 2026. So that's the short story.
Mazel tov, Sean. I'd love to get Nimish and Chen's investor perspective on these concurrent deals. How do you think about it when you're approached by a bank for these kinds of transactions versus a traditional financing where you already have the news announced?
Yeah, I mean, I could start. Yeah, I guess first, Sean's scenario played out nicely and it's working well so far. Not all of these do work, despite what Michael said earlier. So I think that is important to know. I think there are certain scenarios where they make a lot of sense. Like for Cytomics, I think what was helpful is it was an early data cut and it gave investors time to scrub the data. And then the market also now knows that there were a bunch of investors that spent time and went through the data and can ask Sean and his team a lot of questions and were able to get comfortable. For other companies as well, there's times where you have a financing overhang, so you want to make sure this could help remove that, right? Where people expect data but know you have to raise right after, so the stock might not react properly. So that's another scenario where this could help. And then lastly, for certain companies, we've seen it just lowers their cost of capital longer term. Just because even though this raise might not have been at the price you want, then hopefully the next raise is at a higher stock price and the company is in a better spot. So that's kind of those are the scenarios where we see it's a good fit for these companies. In terms of how we view it, ultimately it comes down to what's best for the company. They have to come. There's different scenarios where it makes sense for some, and for others, it might just make more sense to release the data. But when you're unsure, I think it takes a lot of risk off the table when you go that approach.
Yeah, I call concurrent deals kind of like the wildflowers of biotech. They only kind of come out when the markets are difficult, and I think they serve a really nice role of, as Nimish and others have said, of allowing the market to kind of know that the data has been looked at and scrubbed to some degree, and so provides that data validation. I think gives better post-market performance if the deal is done right. But as Nimish said, it doesn't always work out that way, right? So it's not the structure itself that's great. It's hopefully the structure with the right investors in the right context. I would say in general for us, we prefer to do structured transactions in general, meaning we don't actually do as much open market. That's probably it's probably 25-30% of our public portfolio. So most of what we do is going to be in the context of something like that Sean did with Cytomics. So for us, this is actually a little bit more of a focus of us that we almost prefer to do. So it's something that we actually look for very specifically.
Because you don't want to be in the position of reacting and you want to kick the tires more, or some other reason?
It's that, and also we think the companies can do better if we're able to help curate that syndicate and build that investor base in more of a, directed way as opposed to the more random follow-on where it's just like whoever raises their hand first gets the deal sort of thing.
Mhm. So I should note for our audience, if you have any questions, just put them in the chat and we'll address them at the end. But since we've already gotten a bunch of questions on a couple related topics, so I'll just raise those now for our panelists. Um, there are two key themes of these questions. One is, why the hell is this concurrent structure even legal? Sounds like insider trading to me. And the other is, why is it good, or how is it good for the ecosystem, which I think has already been partially addressed. But the legal question, I'll just say, a company can always confidentially provide information to an investor and can raise money off that. That's not a trade. The trade is when that investor goes to sell. And so when that investor goes to sell, that information needs to be out in public so that the buyer of that stock is not disadvantaged in any way. And the concurrent structure allows that, right? Because no one's buying the stock until this announcement is buying from these investors until the data has been fully announced. And so that's why it's not insider trading. But the second question, is this good for the ecosystem? There's concern raised by some audience members that, what we want non-insider investors to keep investing, and if they feel like it's not a level playing field, that some investors are getting an early look and then investing, and then they come in later. How is that good, right? How is that fair? And I think, some of what Chen and Nimish were saying is, well, actually, it helps them understand that the press release is perceived well by investors, and it's not just a puffery. But I'd love to get more thoughts from the panelists on this question.
Yeah, I don't. Oh, sorry, I don't mind starting. So yeah, in terms of the fair, like I'll give you an example. There was a company that just just did this a week or two ago that we were a holder of that we didn't participate, but we were completely glad that they did this because, again, like Chen mentioned, this is not an ideal scenario we're in right now. Like people need to raise money, and we just want our companies to be well capitalized to get to that next milestone. So that it's not like all these companies are saying like, hey, let's just do this deal because this is the preferred route. Like Sean's team in his example debated it back and forth and said like, based on what's happening in the world right now, this just makes the most sense to get us the capital to get to that big readout next year, right? And same with our other company that again we didn't participate, but they did a raise. We were very happy for the team. They got 200 million in capital, and now they're going to be able to run the trial that they want. And then second, a lot of the moves that we saw this week that were positive, that I think Sam or Michael mentioned, those moves don't happen if we don't have successes like Sean's or some of the other ones last week, right? Like it doesn't just like you need momentum to build. You need people to start having some successes to be confident to buy when some of these data sets come out in the open market as well.
Yeah, and I would add from the operating perspective, obviously we're very, very focused on managing risk. And there's a lot of risk in this market. And if you're faced with you have capital requirements, you to go out, raise money to keep running your company, running your programs. It's essential to look at all available tools that you have at your disposal to finance, and we'll talk about some more later on in the panel, and decide what's optimal for you in the context of managing overall market risk. And so I think that's really essential. This is the concurrent deal that we decided to do, again, at a significant premium to where we've been trading over the prior few weeks, was just ended up being a really good fit for us at that moment in time. Is it the right thing for everybody? Probably not. But considering it as we're very happy that this structure exists as an option to evaluate in the context of capital raising and again keeping the lights on.
Yeah. And then you create a syndicate where it's almost venture-like in the public market where you have a bunch of hopefully smart investors who are out there also advocating for the company and telling other investors about why they think the data is interesting and can contextualize that data. And so, like you said, I mean, look at Sedara, right? I think after that deal, they were able to repivot the narrative. Sedara had been known for something else, many years ago. And so for a lot of investors, it's just fallen off, the radar screen, frankly. And so now you can kind of repivot the story with great data. A lot of investors are now primed and kind of aware of what that data should look like, and so you can get rewarded for it. So I think it actually serves a really great purpose in making sure that, especially in the SMID side, we can highlight those companies that deserve that attention.
Great. Well, thank you. Why don't we turn to discussing the pharmas, which have been a very different story than biotechs. They're still minting money. The source has changed from COVID to GLP-1s and other things, but there's still plenty of money around the pharma table. And so when there's a paucity of opportunities in the capital markets, biotechs are ever more eager to partner or get acquired. Would love to get the panelists' thoughts on the trends with the pharmas and how they're thinking about it, what they're seeing. Why don't we start with our investors for this one, Chan and Nimish?
I guess rather. I mean, I actually have. I think pharma, like we don't have an Elon Musk in pharma. If I were to complain, we don't have visionary leadership in pharma right now. I think we have EPS managers and accountants and lawyers. And I don't mean that to be too negative, but it's just that if I were sitting, for example, like if I were looking at this universe and looking at the level of capital desperation, the opportunity to just acquire a whole host of companies for well below market value is just incredible. And so if we could have like a Mayoshi Son who could say, look, I'm gonna raise $30 billion and go buy 10 companies, like I would do that. If I were China, I want to leapfrog all the international competitors, like this would be the time to go buy a bunch of companies. So I have been disappointed in general of the relative pacing that we've seen from M&A. And I'm hoping that in the next 6 months they prove me wrong and they show some courage and get out there. But that's been for me one of the big disappointments of the last year or 2 years.
Nimish, what do you think?
Yeah, that's definitely a very interesting take. And yeah, I agree. I guess, one thing I forget sometimes, there's been so much news and we're trying to navigate like, what does this mean? What do tariffs mean? What do NIH funding mean? And pharma has to kind of make these decisions as well. So our hope is that once they figure out what this is going to mean for their EPS, as Chen alluded to, they'll be able to start focusing again on the science, which is what we do, and identify some of these interesting opportunities to fill their pipelines.
Yeah, I guess I would add that from the CytomX perspective, pharma partnering has always been an essential part of our business plan from the early days. I mean, we realized that to really excavate and develop our technology platform, it was going to take a lot of money. And actually, we've raised, I think, $1.2 billion for the company over the years, and more than about half of that has come from partnering. The most recent deals we did a couple of years ago, maybe 3 years ago now, with Regeneron and Moderna as examples. Yeah, we've done a lot of platform partnering to, again, keep the lights on over the years. And in terms of the current environment, I think in the oncology space, which we're focused in, with regards to IRA, MFN, pricing pressures, complex biologics like antibody drug conjugates and T-cell engagers, I think continue to be of high interest to pharma. We certainly see that interest. And from the standpoint of being able to, maintain exclusivity for longer, maintain, premium pricing. So, we still see positive tailwinds from pharma. In terms of the comment on, M&A and visionary leadership, it is, I think, frustrating to all of us, running our companies and investing in companies to consider just how much more biology we understand today than we did 5 years ago, 10 years ago, 20 years ago. There's still a lot. We still don't understand most biology, of course, but the advances that are being made and the opportunities with investment to translate this incredible science across so many therapeutic areas into meaningful benefit for patients is right there. I mean, so um, there's so much opportunity to make progress, meaningful progress, but the capital is required. And so capital formation models in general, may have to change and evolve over the next couple of years. If we end up in it, if this downturn continues, we're going to have to think of all kinds of creative ways to finance and fund basic research or early stage drug discovery, and pharma should be playing a big role in that.
Sam, we prepared some stats, and I think they're interesting. Maybe I can jump in if we can pull those up. One of the questions that you asked, or the topic of the panel, is keeping the lights on. And so the question is, in a tough financing environment, is the answer deals with pharma? And the stats actually speak for themselves. So this chart shows the number of M&A deals and the total dollar value. But it is truly, statistically and mathematically speaking, this is a flat line. We're at just a constant, roughly 40 to 45 deals per year, every year for the last decade. We're literally, if you take year to date and double it, you're at 48. You're right in in that same range. I think the only variation tends to come from the number of large deals, or one or two large deals here and there that skew the total dollar value. But the number of deals is constant, and I think that reflects a few things. The first is we have a fixed number of buyers, right? There's a fixed number of counterparties on the other side of the table. We have more biotechs steadily increasing, but the number of pharma companies is flat. Second, they are always under pressure. They have been under pressure for at least the last decade. It was, Lipitor patent expiring, and then Nexium and Prilosec patents expiring, and then it was Humira. Now it's, the next up is the PD-1s, etc. So there's always a patent cliff. What is horrifying is if you look at the charts of almost every pharma company, the stock charts, they're flat for the last decade as well. They're all, or mostly flat or below where they were 10 years ago, with, one or two exceptions like Eli Lilly and Novo in particular, the beneficiaries of the GLP-1 trend. So the buyers are constant, the pressure on them is constant, and the number of companies or products that they can acquire is a relative trickle, in that they're looking for late stage programs, and companies that get to phase 3 data or whatever it might be tends to be relatively constant year to year. Maybe again a slow increase, but you don't even see that in the trends here. So M&A is a relatively fixed number, not likely to be the solution for biotech funding. If you look at the next page, you see a very similar trend for licensing. Again, the number of licensed deals is relatively flat, around 300 historically, being a little slower actually in the last few years. And the number of deals this year in particular, even if we double it, we're at 1/3 of the rate that we've seen previously. I think in the end, it's likely to be just a little bit of a blip, and it's maybe, this year is likely to be closer to 200 as people try to get deals closed by year end. But again, this is not, this hasn't been our source of funding for the last few years, and doesn't look like it's going to be our source of funding this year, despite the pressure on all parties in the mix. Pharma companies are really focused right now on trying to fill late stage holes in their pipeline, products that are going to give meaningful revenue actually by 2030. And as you can imagine, with only 5 years to go, there are not many products that are going to solve their problems in 2030 at this point. So the focus, I think, is really on later stage, and you're seeing that in some of the early stage deals slowing down. So again, what that means is more pressure on the biotechs to come up with money from Wall Street. And I think in all of these, the conclusion tends to be you have to have something special to get money at this point. That's I think the bottom line. Whether it's being in an important space for pharma. So right now, ADCs, T cell engagers are sort of flavor of the day or flavor of the month maybe. For licensing, that's where you're seeing most of the activity. A lot of it now going to China as well. But if you're not in the spaces that they're looking for, it's pretty tough to get their attention. And then for biotech, what we're seeing is there's probably 700 public companies or so. About half of those are trading below 25 million enterprise value, many of them below cash. So what we're seeing with investors is a lot of focus on the big caps, the bigger caps, and later stage companies that are performing well, really have no problem raising money. So we did a deal for Mirus a couple of weeks ago, or maybe 3 weeks ago. Stock flew off the shelf. We did deals for Akero and others earlier this year. All of these are later stage with very strong either phase 2B or phase 3 data. There's absolutely no shortage of money for companies like that. Investors are very glad to have late stage, lower risk, more liquid investments. But the other half of of that 700, the bottom half of the 700, it's really challenging. And there, the trend that we're seeing is if you have more than half of the deals, nearly all of the deals actually have been catalyst driven. So you have to have a catalyst, and in plain English, catalyst means data, and it means good data. There are a lot of companies that are putting out results. More than half of those are seeing their stocks go down. So you're down to the half of the news announcements that are positive roughly, and among those, then the strongest are getting funded. And then like Cytomics, you put out, or you have very strong data, you take off like a rocket. You can raise money. Company sort of moves into the into the upper half category, and it escapes from the problem. But for the other, for the 325 or 350 companies that are trading at these very low valuations, I'd expect those that have good data to be funded. Those that don't, I think we're, for the first time in my 30-year career, in an environment where I think a lot of these companies are going to just not have financing available and likely to shut down. And that's actually, I think, probably good for the industry, a culling of the weaker companies in the herd. Obviously, the problem is, some good companies that are just too early, struggling to finance, and that's the greatest challenge.
And by good data, you mean data with no asterisks, meaning the primary and the secondary endpoints, or do you mean something else?
No, that very simple in that kind of it when you see it, but it is absolutely critical that there's no asterisk. You have to have the approach, the target level of efficacy compared to the competition, but then without caveats, right? Without tolerability issues or severe adverse events that others don't have. That's the other driver, I think, in the world we're in now, is competition. Mm-hmm. If you look back 20 years ago, you really had to beat placebo, and that was a much easier bar. Now you have to beat whatever's on the market leader, and that's a much higher bar and much harder to predict when you're early stage.
You're raising a really good question, actually, for the panel. I mean, how do the other panelists perceive the change in the nature of the competitiveness of the industry?
Yeah, I mean, it's just also, and you have to also compete against a Chinese competitor that you don't even know yet exists, right? You suspect will be there, a year behind you. And I think it's kind of talks to this question of just like reinvigorating the entrepreneurial spirit of biotech. I mean, for me, this is a kind of period where we have to look at ourselves in the mirror and say, look, if the Chinese are generating POC for 1/3 or 1/4 the cost that we are here, like that's a problem for us. Like we're either going to have to improve our regulatory environment to allow us to compete there and or get more efficient, which means either we're doing more for less or just cutting our costs. I mean, I use the crude example where, a CEO of a biotech company in the US and even on the private side can be making a cash salary that's like $750,000 a year. Like that's a pharma salary, right? And so like how do you have companies burning, millions of dollars a year in the early stage when you don't even know if the drug works? And I think we have to figure out whether we can recalibrate our model to be more entrepreneurial to if we want to be, I think, competitive and make sure that given Michael's, perspective that look, pharma's not going to have a big bag of money for everybody. Like if you're competing for that same amount of dollars, well, then you better be much more efficient. Otherwise, the sector's not going to flourish.
Yeah, I really do believe, and this has kind of been in our sort of DNA at Cytomics from the beginning, that our job is to take risk and innovate. And I don't think that's ever been more relevant or important for small, mid-sized biotech. But even more so given uh, what we're seeing coming out of China. And again, by way of example, we've been very deliberate in terms of focusing on this EpCAM program because not only are we the first antibody drug conjugate against EpCAM, we're the first masked antibody drug conjugate against EpCAM, and we went into a very difficult to treat disease with a laser focus on metastatic CRC in a phase 1 study, which was a big risk to take. I mean, it's risk upon risk, actually, if you think about that program overall. And it's been great that we've seen a positive reaction to the data that we got having taken that risk. But and all the more reason why when it came to actually financing, we decided to uh, take some of the risk off the table by doing the concurrent deal because we'd already taken so much risk to get the data set. But I think that's really important, and of course all of that adds up to differentiation in this landscape that we're in. We all need to bring forward the most differentiated medicines that we can, and that's I believe what pharma is looking for. So there's kind of a recalibration. You see this a lot in the ADC field, where 20 ADCs against the same target. That's tough. Where's the value creation going to come from across that spectrum of modestly differentiated assets? I think we have to really think about that, and that's so again from our point of view at Cytomics, our technology is designed to do things differently. I just think that's really important.
Nimish, any thoughts? Competition?
Yeah, no, I think Chen's absolutely right. Like the way we do stuff has to change. And I could just give a little bit more on the Venrock perspective, but over the last couple of years, we've been focused a little bit more on bigger markets, right? Just as these pharma companies get bigger, like the opportunities they're looking for also have to be bigger, right? So that's what moves the needles for them. On our private companies, some of them, we stay quiet much more longer, just because there's no reason to announce exactly what targets we're going after, especially if we could help these companies get funding. And so that's something else that we've been doing as well. And then third, just from our team perspective, yeah, I mean, you're going to get asked like who else is doing this now. So we have to, as part of our diligence process, really thoroughly know what the landscape looks like. And that means us asking the CEOs 10 different ways, like who else has this? What do you know? What about competitors X, Y, and Z? But you just have to, because like Chen said, there's going to be someone out there that's doing the exact same thing. So you're hoping you can capitalize these companies, move really fast, and do it in a quiet way. So you get to a point where it's just not worth it for them to try to catch up.
Right. Why don't we talk about ATMs? ATMs for a long time have been part of the standard playbook to have kind of as a form of insurance or rainy day money. But historically, we're not drawn down upon that much. But we have seen that change in the last couple of years, and would love to get our panelists' thoughts on the rising importance of ATMs. Michael, why don't we start with you?
I think the most important statistic is that over 50% of money raised this year, and probably the true of last year as well, has been over 50% has been through ATMs.
That's an astonishing number.
It's an astonishing fact. I have clients. I'm thinking of one in particular that really has a problem going out to raise money. Investors tend to be very skeptical, but the company is quite liquid. In the middle of May, they decided to turn on the ATM, and we're able to get $100 million for them in a month. It's quite remarkable. We had another company that, actually just another company that is much smaller, but has had the same experience. And so it is truly a remarkable product and very important in this environment where if you go to investors and ask for money, you're either going to be rejected or you're going to have to give up a very substantial discount. And so if you can, taking money off the ATM can be a very very efficient way to get money and low cost, relatively speaking. Obviously, for companies that have lower liquidity, it might just not be useful. If you have a company that's trading a few 100,000 shares a day, let's say $1 million or a couple $1 million a day, which is pretty common in biotech, and you're getting 10% of the volume on average, you're getting very little money. It doesn't really do much. But for the medium and larger caps, it's a really powerful tool and can be very effective even for companies that are in the 500 million or more market cap that might otherwise struggle because they don't have a catalyst at a given time. It can be really powerful. And so the advice that we're giving all of our clients is just to make sure you have one and use it as and when needed. But at a minimum, every company we think should have one in biotech.
Jen, I think you were saying earlier they're not your first choice.
Yeah, I think from the company perspective, and what Michael said makes a ton of sense. I think it's obviously an easier way. I think what part we don't love about it sometimes is it gets used a little bit like it's like crack. You get addicted to just pulling off these little bits off the ATM, and then you never do in some cases the structured financing that I think would help them actually build and curate a great syndicate for them. So I think in some cases it ends up kind of moving the company away from what ultimately would be, I think, a better long-term financing strategy versus like a near-term way just to access a little bit of money.
Yeah,
Hamish, your thoughts? Sorry, go ahead.
I was just going to say that we
Go for it.
sorry. Yeah, we certainly have an ATM, and one opportunity that it can afford is if you have an investor who wants to get into the company in a significant way, but is let's just say reluctant to build a position in the open market because of volume or whatever, but principally for volume reasons, it can be a way to get blocks of shares into the right hands, and that's just another way to use it based on inbound reverse inquiry type situations.
Yeah, I was going to say something very similar. On the companies that I've been on the board on or tried to advise, is we like using it in those select opportunities where you're kind of setting up the next financing, where there's someone that you've been targeting and they just don't want to buy it in the open market. And so we'll try to say like, hey, why don't you do a little on the open market, a little on the ATM, which is fair for everyone. But hopefully this sets it up for the next financing where you could participate in a much larger way, in a more structured way. There are companies that we've seen in the past, like just doing it in a little bit of a random way, and it just becomes tough when you're thinking about buying that stock. You're like, well, what's the rush? Why am I going to buy it? They could just keep hitting the ATM. So I agree with Sean's approach, and that's what we like our companies to take as well.
Mm-hmm.
Let's talk about reverse mergers. So historically, reverse mergers have been kind of the dog's breakfast of capital markets. When times are bad, they tend to surface much more frequently than when the markets are robust. And the basic idea is a company that's failed, that has bad data and can't continue its operations still has value in that it's sitting on maybe a lot of cash and a NASDAQ listing, which itself is quite valuable, particularly when traditional IPOs aren't happening in great numbers. And so they merge with a private company that has operations and is generating data. And so it's both a capital markets transaction and a merger, and often there's a pipe of where new money comes in a private placement. But in the last couple of years, that's been challenged by activist investors, Kevin Tang and others, arguing that the fallen angels with bad data and discontinued operations are best off liquidating and distributing their cash rather than merging with a private company. So would love to get the panelists' thoughts on developments in reverse mergers and how they see the value there. Why don't we start with our investors?
I mean, I'm less negative on them in the sense that I think, look, we were in Moonlight, right? That worked out really well for both the private side and the acquiring shell, right? So I think it really is kind of deal specific. I think, kind of Kevin Tang's approach on certain companies makes a ton of sense. If you don't trust the management or the board to make a good call on what that asset's going to look like, it's absolutely better to liquidate. So I think of it more as a case by case. I think for me, I don't know, the negative perception of reverse mergers just as like a brand for me is gone. Like for me, I just look at them purely as, do I think this asset looks interesting or not, as opposed to like all reverse mergers are bad. So for me, I think it's another tool in the toolbox, and I think it's something that I think we should continue to use.
Yes, similar to China. We've led a number of reverse mergers over the last 2 to 3 years. And Live Inspire, Jade, Cogent, Viridian. And a lot of it is not exactly like Chen said. It's more a preference of we just want to get these companies public fast and give them more access to capital, opposed to some, ideology on just reverse mergers. Because again, like we said earlier, like given the competitive landscape, we want our companies to get capitalized very quickly and go after these big opportunities, and then they can kind of just focus on that. I think in terms of bringing up Kevin Tang, I think you're more looking at it like after a company has bad data, do you decide to go a reverse merger route opposed to whatever the other options are? And there, we're kind of agnostic. Sometimes we sell because we could sell on the open market. It's kind of just up to that board and that company on what they think the preferred route is for them. But in terms of a tool, it's a tool we use often and we like.
Right. Michael, your thoughts?
I actually think that as Nimish is actually referring to, there's two different kinds of reverse mergers. There's probably more, but fundamentally two. The one is where you've got a broken company with a lot of cash that goes and does a big process and speaks to 100 private companies and tries to pick the best one. That's, I think, what most people think about in reverse merger, and I'll come back to it. What Nimish and some of his partners have done brilliantly is starting companies or finding companies, lining up capital led by Venrock, and then putting that company into essentially an empty shell with little or no money, and really funding the company with a new syndicate, but putting it, taking it forward as a public entity. I think that's a great idea. It capitalizes the company well, and then sets you up to be public on the next milestone and the next financing. So Nimish mentioned a few examples, but they've done many, and I think almost all have been successful. So it's clearly a great formula. Where I think the negative part of that or this concept, the reverse merger concept, is where you have a board of a private company that would like to go public. The market is obviously shut, and so they say, go do a reverse merger. And the private company then proceeds to spin their wheels on trying to do a reverse merger for the next 6 months and comes back empty-handed. Why do they come back empty-handed? Well, first of all, the number of target cash shells that have money is limited, and they are each doing a competitive process to pick the best company they can find. And it's all very subjective, very biased in the way the process is run. And for the private company, you have no control of the outcome. You could be one of two finalists picked in a 6-month process and get to the end of the 6 months, and the cash shell picks the other company. Or even worse, you can go through a 6-month process. You're the chosen one, and then the investors, usually led by Kevin Tang, shut down the deal, and the deal gets rejected. So it's truly not a reliable funding approach, and so I think it's really deeply flawed. And now, of course, what we're seeing is with companies that have substantial amounts of capital, which I would say is anything 75 million or above, sometimes even less. Kevin Tang and others are offering the boards and the shareholders a way to shut down the company and give the money back, which is very difficult unless you have a buyer. Because if you shut down a public company, the board remains on the hook. Liability continues for a few years, so they can't just shut down the company. Kevin Tang is really giving a viable exit, a ramp off the highway for boards of directors. So it's very helpful to have Kevin doing this, but the challenge is it's taking away yet another financing source for companies. Regardless of any of this, you have to have investors behind you for a pipe to do a deal like that, or to do a deal like Nimish is doing. So as long as you have investors lined up, you'll have no difficulty doing a reverse merger if you choose to go that way, as Venrock has done on many occasions. So I think it's a great idea for private companies that are where getting public may actually tip the scale in their favor. And so if investors can get a public security in an otherwise private placement, it can be quite attractive and can make them lean in instead of lean out. But the traditional reverse merger, where you're merging with a cash shell that has a meaningful amount of cash, I think that's just not really a reliable or viable option.
I would just add on Michael's point. I think what I've seen is that if the private company does not have like a board, like meaning they are not compelling to the key board members of the public shell, like you're toast. That open process, like you described, Michael, is really not that open, right? It's really who are the key board members on that public board who like whatever targets they like, and if they don't like it, it's just not happening. So I think it is incumbent if a private company is exploring it to make sure that they essentially have investor interest from those investor board members on the public shell.
As a final alternative of capital raising, let's chat about royalty monetization briefly. Historically, it was only the small number of companies that were commercial that were able to consider it. I think in the last couple of years, companies asked the question, can we use it for launch capital or even development capital? Michael, you want to start us off with your thoughts on that?
Yes. And today I'm smiling because all the statistics got rewritten this morning with a $2 billion deal for Revolution Medicines done with Royalty Pharma. I haven't had an opportunity to drill down because I've literally been during this panel when I saw the news. But what I did see is they got 250 million up front, which is not 2 billion. It's still a lot. It's more than I got lying around to give anybody on this call, but 250 million up front, not 2 billion, but it's a lot of money. What is important to know, it's actually like reverse mergers where the board is under a lot of pressure, and so they say to the management team, go do a reverse merger. Boards also do that to their public companies where they're struggling to raise money. They're in phase one, and somebody at the board, around the board table says, go do a royalty deal. I think the reality is that the royalty product is a very useful product, but it is for almost every situation. It's a post phase 3 data or later instrument. There are probably 20 royalty players in the market today. Of those, there's really only one player that does a meaningful number of deals pre-phase 3 data, and that's Royalty Pharma. Royalty Pharma does most of the deals at all stages. They're the most competitive, they have the lowest cost of capital, and they're the largest. So they do almost every large deal. That's later stage, but as far as earlier stage, they're the only ones who will take on some risk, and even then, it's on very rare situations like Revolution Medicines. I mean, RevMed is, I don't cover RevMed, but obviously a very successful company in the spectrum of biotech development stage. And so, there's a situation where a company can raise capital through a royalty instrument, but 95+% of companies that are in phase 2 or phase 3 are not going to be able to get royalty financing. It's too risky for these funds. So that's my take on that. I've been very active in the business for the last couple of years. It is a very important source of capital. Actually, I will add one more thing, apologies, which is there's the concept of short the launch, which you hear investors talk about and companies talk about, which refers to the difficulty of raising money once you're approved as a biotech company. So that is true. It's not, I don't think it's so much a short the launch phenomenon as almost every biotech investor in our industry is a PhD that is all about the scientific experiment. Will the trial work or not work? They're not experts in IP and reimbursement and market penetration and all that, which is what happens after approval. So there's really no buyer universe post-approval. And that's where the royalty funds are so important, because they're actually, that is their sweet spot, is the day after the NDA gets approved. And it's literally when the rest of the biotech community wants to walk away. So it's very, very important for our sector to have that source of capital.
Well, we're basically out of time, but if any of our other panelists have any thoughts on royalty monetization, we can close with those.
Agree with Michael.
All right. Well, I want to thank each of our panelists. I think collectively among them, they have something like a century's worth of experience, and really appreciated their insights today. Thank you, everybody.
Thanks, Sam.
Thanks, everyone.